There are two key metrics in the insurance industry that anyone that works in that industry needs to know. Those two key metrics are your claims ratio and your operating expense ratio. So in the insurance business, again, because it's about managing risk, you've got to be able to measure that risk and support that risk. So there are two very, very key, very, very important metrics in the insurance industry. One of them you call a claims ratio or a loss ratio or a benefits ratio. It is the proportion of your premiums that you're paying out in claims. So claims divided by premiums, or benefits or losses divided by premiums. A good example of that is the Affordable Care Act. So back when the Affordable Care Act was passed in health insurance, all of a sudden health insurers had to pay between 80 to 85% of every dollar in premiums back into claims. It was a regulator's way of making sure that companies aren't charging too high and aren't earning huge amounts of profits. So making sure that they're serving their members. So think about what that does. As an insurance company, if I have to pay between 80 to 85% of every dollar in premium, that only leaves me 15 to 20% to pay for everything else, to pay for the support of the business. So number one, make sure you understand what that benefits ratio is, or that claims ratio, that loss ratio, however your company looks at it. It manages or measures the way that we're managing risk. Some of it, and actually most of it, is very highly regulated. Property and casualty, health insurance, very highly regulated. So we're limited on the amount of money that we have to pay for the rest of the business, which leads us to the second major metric. A lot of companies will call it an expense ratio, an operating expense ratio. Some may call it an other underwriting expense. Essentially, it is the overhead divided by revenue. That percentage is monitored very, very carefully because, again, if premiums are your major revenue, there's only so much to pay for the rest of the support. So again, in your insurance business, make sure you're measuring your claims ratio, and that'll give you a good indication. If your claims ratio is creeping up higher, guess what? There's less money to pay for everything else. So we're gonna be working on that cost lever and driving costs down. As that claims ratio comes back down, that may free up some capital then to be able to reinvest back into the operations. And then make sure you're also measuring that operating expense ratio. If you're seeing that tick up, guess what? You're gonna see some pressures on that. You're gonna see drives and initiatives to automate, to make things more efficient, to speed things up, and ultimately make it less costly. As you're looking at those two key metrics, the claims ratio and the operating expense ratio, someone with good business acumen will know exactly what's going on, right? A claims ratio only goes up because underwriting or the models were wrong, or the assumptions and just reality bucked assumptions. Well, you've got to make up for it somewhere else. And so we're going to look at that operating expense ratio. Someone with good business acumen will know those two numbers and be able to predict what's coming down the pike. And as you can predict what's coming down the pike, you're going to gain better influence, you're going to make better decisions, and that's just good business acumen.